Welcome to Smart Stock Watch, your go-to channel for in-depth financial analysis. Today is July 22nd, 2025, and we're diving into the second quarter earnings report of Zions Bancorporation. Joining us is John, our senior analyst from Smart Stock Watch. John, thanks for being here.
Thank you for having me. Zions Bancorporation, a leading financial services company, has just released its Q2 2025 earnings report, and there's a lot to unpack. Let's get started.
Revenue and profitability overview. Let's start with the top line. Zions Bancorporation reported net earnings of $243 million and a diluted EPS of 163 cents for the second quarter of 2025. John, how does this compare to their previous performance?
It's a strong performance indeed. Compared to the same quarter last year, net earnings increased from $190 million, and the diluted EPS rose from 128 cents. This growth is largely driven by a 9% increase in net interest income, which reached $648 million, and an improved net interest margin of 3.17%, up from 2.98% a year ago.
That's impressive. What factors contributed to this improvement in net interest income and margin?
The increase in net interest income is primarily due to lower funding costs and a favorable shift in the composition of average interest-earning assets. This includes growth in average loans and money market investments, which helped offset a decline in average securities.
Operational efficiencies and future outlook. Moving on to operational performance, Zions reported an adjusted pre-provision net revenue of $316 million and an improved efficiency ratio of 62.2%. John, what does this tell us about their operational efficiency?
The improvement in the efficiency ratio from 64.5% last year to 62.2% this quarter indicates better cost management and operational leverage. The adjusted PPNR increased by 14%, reflecting strong revenue growth relative to expenses.
And what about their future outlook?
CEO Harris H. Simmons expressed optimism about the second half of the year, citing stable deposits and a 4% increase in average loans. He noted that while there are signs of moderate economic slowing, the overall performance has been better than expected, and they are more optimistic about growth in the latter half of 2025.
Credit quality and capital position. Let's discuss credit quality and capital position. Zions reported a negative provision for credit losses of $1 million. What does this indicate, John?
This negative provision suggests that Zions is seeing improvements in credit quality, allowing them to release some of the reserves previously set aside for potential loan losses. Non-performing assets increased slightly to $313 million, but the overall credit quality remains solid.
And how is their capital position looking?
Their Common Equity Tier 1 (CET1) capital ratio improved to 11.0%, up from 10.6% last year. This indicates a strong capital position, providing a buffer against potential economic uncertainties. However, classified loans increased to $2.7 billion, which is something to monitor closely.
EPS forecast and analyst expectations. Now let's talk about the earnings per share. Zions reported an EPS of $1.63, significantly beating the analyst forecast of $1.31. John, what does this mean for investors?
This is a substantial beat, with the actual EPS exceeding the forecast by 32 cents. It reflects the company's strong financial performance and effective cost management. Beating analyst expectations can boost investor confidence and potentially lead to positive market reactions.
With 11 analysts covering the stock, this beat is quite significant. How might this affect their stock price?
Such a positive surprise often leads to upward revisions in analyst ratings and target prices, which can drive the stock price higher as investors adjust their expectations based on the new information.
Key takeaways. In summary, Zions Bancorporation delivered a strong second quarter with impressive earnings growth and operational efficiency. Their robust capital position and improved credit quality further enhance their investment appeal. John, any final thoughts?
Zions has demonstrated resilience and adaptability in a challenging economic environment. Their ability to beat EPS expectations and maintain strong credit quality positions them well for future growth. Investors should keep an eye on their loan growth and credit quality metrics moving forward.
Thank you, John, for your insights, and thank you to our viewers for tuning in. If you found this analysis helpful, please like, share, and subscribe to Smart Stock Watch. We'd love to hear your thoughts on Zions Bancorporation's performance in the comments below.